All right. So I want to set the stage. Today, we're really going to talk about like how do you start investing in startup? How do you become an angel investor? But first off, I want to set the stage here, like why even invest in startups? Like why did I get started? So if you look at here, the wealthy individuals in San Francisco, the majority of them are either investors or they had a startup that exited. Actually, in San Francisco and in tech hubs, startup create the most wealth. Just in Palo Alto alone, the startup exit and the capital gains from investment make up actually 75% of household income, surpassing wages. Even myself, like I was an engineering director, I was managing 50 engineers, and even then, even though my company exited, like I never had the type of wealth that investors had. So that really started motivating me, like, how are people making money? And it's really by investing in startups. And I really believe that now with AI growing, this is our time to go in on ground zero. And so to make a lot of wealth that we can then use to, either make the world a better place or just retire, whatever you choose to. Another also reason to invest in startup is like venture actually returns and beat traditional investing. So when you invest in, it's higher risk. Of course, there's a lot of risk involved in being in startup, but startups can give you 100x return on your investment via stocks, which do like 7 to 10% annually. For example, the angel investors who invested in Uber, even with their 25K check, now have $125 million in return. If you were an early investor in Airbnb with 20K, you have 80 million. And with OpenAI, early investors saw like 10,000x growth. Like there is no higher reward than investing in startups. And then also another way is like you just diversify your portfolio. And startups are usually not correlated with the stock market. Like right now, the world is a little bit crazy. You don't know what's going to happen. But startup usually are isolated from that. And then another reason to invest in startups is you get early exposure to all the coolest technology happening in AI and biotech and space and climate tech before they even go public. So you're really at the forefront of technology. And I wanted to detail out, okay, well, you want to invest in startups. How do you get started? Well, first, this is really important. The SEC does not allow you to invest in startups until you are considered an accredited investor. What does that mean? It means you have 1 million in net worth or you have 200,000 annual income for the last 2 years. If you're married, it has to be 300,000. Again, if you don't meet those two criteria, you cannot angel invest, unfortunately. Um, the second part is okay, figuring out startups have a lot of stages. There's pre-seed, seed, series A, series B. What stage of startups do you want to invest in? Do you want to do maybe higher reward? It means that you have to invest in pre-seed and seed. But of course, it's higher risk. Again, there are risks in investing in startups. Like 90% of startups fail. Or do you want to go in series A and beyond? There's more traction. It's lower risk, but lower reward. The third is to really set an annual investment budget. How much money do you want to invest in startups? Do you want to do 10,000, 50,000, 500,000? And in here, really what's most important is diversifying. Make sure that not all your net worth is going in startups. And if they are, make sure that you have at least 20 startups in your portfolio so you diversify your risk. And again, I'm not a financial advisor, so talk to a financial advisor about that. And then figure out what is your risk tolerance. Do you want to, are you a higher risk, are you tolerant with higher risk? Go early stage for bigger return. Are you a lower risk tolerance? Invest in later stage startups or have a balanced approach, a mix of early stage and later stage. And then the fifth thing to do is to choose a method to invest in startups. And we're going to go through that today in details. All right, so here are different ways of investing in startups. And I'm not going to take questions now. What I'm going to do is after this, I'm going to open up and we're going to have a Q&A. All right, you can do direct angel investing. What does that mean? It means that you actually find one startup at a time, and you go to that startup and you invest directly into it. And typically that happen at pre-seed or seed stage. And every check is typically between $10,000 and $250,000 per deal. For example, let's say you go to a networking event and you meet a startup that you really believe in. You can actually go to that startup and tell them, "Hey, would you accept my angel check? It's a smaller check, but you're really the one controlling who you're investing in." The pro about being an angel investor is that you have full control over your investments. You decide for every dollar where it's going to. And then if you pick the right startup, let's say you invested in Uber, again, you get crazy returns because you invested before anybody else. And then you have direct access to founders and decision making because at that point you forge that relationship with that founder. You're giving them money directly to them. The con of angel investing, and I've been investing for a long time, that's why I'm not like a super fan of it, is that it's very high risk. Again, diversification is key. And then let's say you invest 10K in two startups, right? The chance of one of them succeeding is actually very low. So you can't really diversify. So then it takes a lot of money to actually diversify your investment. So it's very high risk. And then it requires a lot of time and expertise to evaluate deals. You have to look at their valuation, at their pitch deck. You have to do like financial scenarios and return. And then it's also very hard to get access to top tier startups. Not all of them go to networking events. And really, the way that you get access to angel investing is like through your one-on-one connections. But a lot of top tier startups are not your direct connections. So that's the first way, the easiest way. The other way is to join an angel syndicate and investment group. So for me, angel investing did not work because again, I heard that you have to invest in like 30 to 40 startups. And at that point, like let's say you're investing 10K, that's 300 to 400K of your own money just to diversify. So then I joined an angel syndicate. I joined Shack 15 Venture. And what is an angel syndicate? It's basically a group of angel investor and they pool their money together to give it to a startup. So let's say there's 10 angel syndicate, everybody puts 10K, and then you have 100K. You take that 100K and you invest it in one startup. Typically, the minimum investment is between 1K to 50K per deal. It varies by syndicate. What is good about angel syndicates is like the angel syndicate head typically finds the startups for you, and then they present you with the startup and they're like, okay, how much money do you want to invest? They pool that money together and they invest it in that startup. So the pros about it is that it's lower barrier to entry. You invest in startups with very small check. You get access to better deal flow because it's sourced by experienced investors. And then the investor themselves, they do the diligence on that startup, which is really awesome. So for example, my experience with Shack 15 is like they present maybe one startup every quarter. They go to all the angels and they're like, okay, who wants to invest in that? You can choose to invest in it. They already did their due diligence. So the con of that is that you don't really have control about which startup you invest in. You just get presented with startups, so it's more passive, and you still have to pay like carry on the profit that you make, and you still need to, require active participation to choose deals. But I think the biggest con is like also similar to Angel Syndicate, is that you're investing in one startup at a time, right? So again, even if it's 1K, I'll probably have to invest in 40 startups to be able to diversify my money. So Angel Syndicate, while it's great, they still have a much higher risk. So the third way is like a traditional venture capital fund. What is a fund? A fund means that you have select investors, they take money from people, you invest directly in that fund. Your money is pooled with other investors, and then the investors then take that pool of money and diversify it into many, many startups. What is good about that is like one, you don't need to find the deals, the investors will find a deal. And then instead of you giving, let's say, 10K for one startup, you're giving maybe 100K, but it's across like 40 to 100 startups. And then you can join that as a limited partner. Typically, the minimum investment is 100K, where you can join as a limited partner and then you still get the return. The biggest pro is that it's diversification, right? You get exposure to at least 20 to 30 startup instead of betting on one. It's expert led. Usually it's investors with a good track record and they have like deep network and experience. And then you will get access to top tier deals because what happened is like startups on their cap table, they typically do not want to have like 100 investors on their cap table because it doesn't look good for their next round. So they typically like to get money from institutional investors because then it's like one investor. And then another thing is like a lot of investors provide value add beyond the check. They provide a network, they provide expertise. So you get it. So there's a higher chance that really good startups would take money from a venture capital fund than an angel investor. The con is it requires larger capital commitment. There's less liquidity. Usually funds have a 10-year cycle before they exit. But let's say you invest 100K in a fund, and let's say, one of the company exits within the 10 years, you get the return right away. But typically, unless companies exit, it's a 10-year fund. So you only see returns after 10 years unless there's like an exit. And then the another con is you don't choose the individual startups. It's really the investor who chooses that. All right, how to choose? Like, how do you make a decision? Well, if you want to have better control and big upside, and you really want to choose who you want to invest in, you have that time, direct angel investing would be great. If you want expert vetted deals with lower risk, an angel syndicate. But if you want to really diversify and you want a top tier access, then I highly recommend you go with a venture fund. And then what is the best strategy for you? I always recommend always mix, like invest in stock market, invest in venture funds. So then you get experience in each one of them. All right, so how do you get started? Now you want to angel invest. What are the steps? And here I detailed out this exact step that you need to take. Well, you have one option. The first option is go solo, become yourself an angel investor. The number one thing that you need to do as an angel investor is find great startups. And how do you find great startups? Well, you go to your personal network, ask friends, colleagues, ask other founders in your industry to refer you to startups. The second thing is accelerator incubators are a great way to find startups. Y Combinator, every time they have a batch, they list out all of the startups in that batch. So you can go and then you can look at that list, you can look at industry trends, you can even try to connect with those founders. Techstars and HF0 are other accelerators that are also highly popular in San Francisco. So you can go to their website and take a look at the startups there. Another thing is Angel Platform and Syndicate. Their Angel list has a big list of startups happening. There's Seed Invest, there's Republic. And then also the fourth way is networking events. At Founders Bay, we do weekly dinners, monthly dinners. We have like pitch nights, but also you're in San Francisco. Like I have this newsletter.foundersbay.com, and every week I report on all of the founder events happening there. A lot of the founders are there. So just start networking and building that network. So now you know how to find great startup. The second part is you want to learn how do you evaluate a startup. And that is more personal, right? But what I found is the reason why every single company that I joined like ended up exiting is because I look for a few things when evaluating a startup. One, the founder quality. Are they resilient? Are they experienced? And one of the things that I look for in a founder more than anything else is like, do they have the hustle factor? Because the reality of it is like, even with all the experience that you have, building a startup, you need so much skill sets. Like you need to learn about finance, about marketing, about AI, about technology. Nobody really has that experience. But if you have the hustle factor, that means that you're going to figure out how to learn. And that is something that makes great founders like amazing. And then I look at the market size. Is this $1 billion opportunity? Like again, when you invest in a startup, by the time like it's diluted, by the time it exited, you want to make sure that this can be a unicorn. That's what you want to optimize for. The fourth thing is I do look for traction. Like if it hasn't been proven yet, and if people are not willing to pay for your idea, then you have a hobby, you don't have a startup. Do they have early customers or revenue? And another thing also that I look for in traction is not only customers and revenue, but also distribution channels. Like in the past, before, what made a great startup is maybe an idea. Like this is where the Uber and the Airbnb of the world came in. These are like they really redefined industries. But now, what is making a startup succeed is your distribution channels. Like if you look at the most popular entrepreneurs now are typically influencers because if you have a distribution channel, then you can sell whatever you want. And then differentiator, what makes the startup hard to copy? What is an advantage that that founder has that nobody else has, right? Is it the network? Is it a following? Is it maybe deep expertise that nobody else has? So if you look at these four things, typically you can identify if a startup has a chance of succeeding. Step number three, okay, well, this is where you need to really learn about like the financial aspect because you need to negotiate the terms. What percentage of the company are you buying? What is the valuation of a startup? Are they doing safe vs equity? Is there like pro rata rights? So all of that you need to learn before you do that. And there's an amazing book that I forgot the name now, but I'm gonna send it to you. I think it's called Venture Deals, and then it teaches you exactly about what all of this means. And this is my warning to you is like what negotiating terms can be complex. Typically, like VCs and top angel usually set the terms, but if you're just starting out, you don't really have that negotiation. But I would just advise you to really like learn about it before you do that because like let's say somebody you're saying okay you know what I'm investing 10K, I'm getting 0.01%, but if let's say the terms make it that you get diluted, even if that company becomes a unicorn you may just make like 100K out of it. um and then step four, sorry, I don't know why I put six. You need to manage the investment, right? You need to track the startups, you need to track the financial update, you need to handle legal and tax documents. And then you also need to like find exit opportunities. Let's say you invested in a startup at a pre-seed and it's doing really well. You actually don't need to wait until it IPO. You can sell it in secondary market. But all of that takes like hands-on experience. And then most angel investors, they invest in 20 to 30 startups to spread risk. So you really need a mechanism to manage all of that. All right. So this is the hard truth. Going solo is high risk. It is also very high reward. You know, the upside is you get full control and you potentially get massive return. The downside is that it's time consuming, it's risky, and usually require expertise. Um, but if you want to find an easier way, you can invest through a syndicate or a fund. So you get like at least expert vetted deals and they do all the negotiation and all the due diligence on your end. And then you don't really have to keep track of everything. So the other way to get started, if you don't want to go solo, is to join a syndicate or a fund. So what that means is you're investing with experienced investors, and then you get access to top tier deals. And again, as I said, like what I want with Founders Bay is we're building community. We're building an ecosystem where we can all thrive together because like especially now with everything that is happening, having each other's back is more important than ever. And that's why we launched our AI and Frontier Tech Fund with Founders Bay. It's really a community fund. So we can all take advantage of AI together. We can all learn together and grow together. There's no reason why we can't all get wealthy together. And we want to give you a chance to invest alongside experts. So I'm going to pause here. And before opening it up for questions, I want to talk to you a little bit about our fund. And I know Kristopher will talk to you a little bit about it.
All right, let me come back on to video here. Okay, cool. So this is exciting stuff, folks. This fund is brand new. And when I say brand new, I mean we published, this kind of made me nervous, but we published the first draft of our investment thesis actually on LinkedIn yesterday. So in the spirit of building in public, and I'll drop that link here in a sec when I'm done talking, so you can check that out. Again, it's draft one, right? So we'll continue to refine it. But let me just talk a little bit high level about what we're thinking here. So the vision for this fund here and the kind of the mission statement, right? We're looking at a very unique moment in time where there's just some really big macro trends. Like this really kind of calls to like the futurist in me, right? Like we're reinventing society right now, and the tech innovations that we have, in my opinion, are much more exciting than some of like the cloud SaaS stuff that, has kind of really dominated for the past, 10, 20 years. So what we're looking to do here is catalyze this transformative innovation in frontier tech during this like pivotal moment that we're in. I kind of look at really the 2020s, I think, as just being a very, very, very um, meaningful decade for human civilization, and the tech transformations that we're seeing during this period, I think, are really driving that. So we have this thing we're calling epic optimism, right? And so it's, kind of think big and think positive, right? A lot of folks are, scared of AI, right? A lot of people that, maybe you have friends and family who aren't in tech and are kind of terrified about robotics, taking jobs, like all these different kind of stories that are out there. And we choose to look at this with an epic optimism framework and say this is a unique opportunity to kind of take advantage of all these different disruptive domains that are scaling simultaneously. Um, the focus areas for the fund are going to be, again, mapping to these transformative changes. So we're looking at things like AI, robotics, biotech. I'm a big sustainability guy, so sustainable transformation, even though it's sort of not in right now politically, but it's something that's still going to be meaningful. And my personal favorite, space exploration. So for the sci-fi nerds out there, space is actually becoming a serious conversation in business, which is great. And, again, just to kind of double tap on that, like if you think about this, um, these high growth sectors are not theoretical. Like this isn't sci-fi anymore. Like this is stuff that's really happening. And we're going to see these technologies manifest in real economic gains over the next, 10, 15 years. And that's what we're really excited about. I mean, if you think about, things like AI, biotech, sustainability, all these things are adding trillions of dollars to the global GDP and really reshaping traditional industries. Everything's going to be reinvented, right? Everything that's been, invented and worked on over the past 10, 15, 20 years, it's all up for grabs. Um, so that's something that's very exciting, and that creates a unique opportunity for us. So not only do we have the transformation of, things like what is AI doing to SaaS, right? Like if you take a look at that alone, we're looking at boosting global output by, I think, around somewhere 15%, which is adding more value than the GDP of India and China combined. And that's by 2030 or 2031, the early 2030s. And so that's massive. Like these are huge tectonic shifts in industry, capital, and technology, and we're positioned to take advantage of that. So a lot of folks talk about, is venture capital dead? Like that's kind of a big conversation right now, right? Is VC, going through sort of a bust right now, or kind of what's happening, right? And so we look at this as like, hey, this is a short-term correction that's providing opportunities for long-term growth and for transformative growth. Yes, venture has pulled back from the 2020s, right? Or the early 2020s. So 2020, 2021, overall investment last year, I think, was down 25 or 30% year over year. But this is a reset, right? That's the way that we look at this. This is a reset. This is like a correction period. And so, what does that mean? That means there's outsized opportunity. If you look at the investment vintage right after the dot-com bust, for instance, that was one of the best vintages of all time, right? And right now, also, there's a ton of dry powder. I think I read somewhere there's like 25, 30% of assets under management are actually just capital, like just waiting to be deployed. And folks, the venture community is kind of scared about deploying that capital. But again, like we're really kind of beating the drum here of epic optimism, of huge opportunity, of investing in these transformative tech layers that are going to just completely, and not only are they interesting alone, but think about the convergence and the synergies between them, right? So, robotics, biotech, AI, like all these things are going to create trillions of dollars just individually, but then they're also going to kind of come together and create huge opportunities. So that's something that we're super excited about. And I think we're not the only ones, since kind of putting the word out there that we're raising this fund. Again, we're super early stages, but we already have like a ton of commits, and there's a ton of people who have reached out to us individually and are super excited about specifically the investment thesis and the optimistic viewpoint that we have when we talk about investing. So anyway, back to the slide here. So our unique edge is you, right? Like that's our secret sauce, right? It's the Founders Bay community. It's the fact that we have 45,000 and counting. I think we're probably going to cross 50,000 over the next couple of weeks here, right? So this is a community that's growing. I kind of think about it as almost like a virtual accelerator, virtual venture community. We have, a significant portion of that community is based in San Francisco, which, love it or hate it, is still kind of the center of the world in terms of tech innovation. So, we really draw upon the, kind of the key to success when you're launching a fund like this, right? It's access to deal flow, and we have insane access to deal flow. And so we're super excited about bringing all the aspects of our community together and leveraging capital that's in our ecosystem for the founders that are in our ecosystem. Could we go to the next slide, Mariane? Okay, I won't spend a ton of time on this. I'm going to talk about kind of the top part of this, and then I'll turn it over to Mariane to take us back to the angel investing focus here. But we do have opportunities for different classes of investors. And again, I'll drop a link to the application portal and to the investment thesis when I'm done talking, so you can go look at these things yourselves. But for institutional and high net worth individuals who want to be LPs in the fund, we have a couple of different models and different check sizes. You see here, we're really looking at 250K and above, and that can be just one check, or that can be kind of split in 4 years. But what we're going to do with our high net worth individuals and our institutional money is really, obviously they're going to have access to all of our market insights and kind of see behind the curtain with how we look at deal flow and what we think the trends and drivers are for these concurrent waves of innovation. Also, we have a ton of VIP networking events. We're mostly based in San Francisco, but really all over the country. And we're also going to provide direct co-investment opportunities for folks who are in that bracket of engagement. They'll also, we'll give them strategic introductions to portcos and like potential prospects. They'll be able to participate in various advisory roles if they want, right? They can be silent and just deploy capital and let that be that, or we're gonna allow for different levels of engagement so that they can leverage their industry expertise. Like we're definitely interested in talking to strategic LPs who can provide more than just a check. We love those folks, and we're going to give them opportunities to have access directly to our founders. And then of course things like priority access to follow-on rounds and different bespoke investment opportunities especially as we get to know those LPs, right? Like what they're looking for their portfolio. Like again, just kind of leveraging the synergy of the Founders Bay ecosystem in general, just to provide them with the kind of opportunities that they're looking for. I think I'll cut it there, Mary, unless there's anything else you want me to double tap before we turn it back over to you.
Yeah, thanks, Chris. So another thing that we wanted to do, right, is like, so this fund, we already got over like 110 million in soft commitments. But at the end of the day, like we're not doing this fund for anything else than like building community for this community. This is really a community-led fund. And I would love for each one of you to be involved. So I was thinking, okay, we're not all high net worth, right? Like it's very hard to get 250K and invest that. But if you want to become an angel investor, we want to help support you. So we are having a special program, and we're creating an angel group with $10,000 only. You can learn more about investing. That means that your money is get pooled in that fund. So you get the best of both worlds, because then you're de-risking it because you are in the pool for all our investments, but you don't need like 250,000. You only need 10,000. And then you get access to our pre-seed startups. You get to meet with them. You get to learn what does it take to really invest and how do we evaluate like pre-seed and seed startups. We are only taking approximately like 100 angels. So Chris here is gonna put the link if you want to start investing and you want to learn about it and become part of our angel LP group, you can apply to join. Given that we already have so much applications, We're probably gonna take a look like in the next 2 weeks. So, but if only with 10K you can start investing with us. We want all of us to really take advantage of this. Like this is really community focused. Um, all right. So yeah, join us. The best way to build wealth in tech is by investing in startups before they become unicorns.